This week is all about sorting through the noise and focusing on what really drives portfolios: growth, inflation, and earnings. First, with the government finally reopened, we started to get delayed economic data back. The September jobs report finally hit, and weekly jobless claims are still running in the low 200,000s. That tells us the labor market is cooling but not cracking, which is exactly consistent with this soft patch, not free fall narrative we've been talking about. Second, the Fed is back on center stage. Several Fed officials have pushed back on the idea of an automatic rate cut in December, and markets have pulled down those odds. At the same time, market-based inflation expectations have rolled over, and inflation today is actually not far from its long-run average. In other words, policy is restrictive, but we're moving in the right direction on prices. Third, underneath the headlines, corporate America is still delivering. For the S&P 500, third quarter profit margins are running around the highest levels we've seen in more than 15 years, with earnings growing faster than the overall economy. That strength in profits is a big reason why the broader market has held up, even as leadership rotates away from some of those big tech, big AI winners. So what does it all mean for you? In the near term, we should expect some choppier days as investors react to every Fed comment and every AI headline. But a cooling, not collapsing economy, anchored inflation expectations, and healthy corporate profits are exactly the kind of backdrop where staying diversified, sticking to a long-term plan tends to be rewarded. Thanks for tuning in. We'll see you next week with more insights.